G'day everyone, Greg Canavan here with you. It's Monday morning, the 8th of April, with the Rum Rebellion update. This week I want to go through a number of charts that I've showed you in the past, just to sort of, I guess, bring you up to speed on a couple of those important asset markets. I've showed these charts in the past to give you an idea that, you know, if they break certain levels, then it might be an indication that the bull market that we've experienced since the start of the year is coming to an end. That hasn't really happened on a number of charts, so it just goes to show the impetus the markets have had from central bank easing and central bank liquidity, all those sorts of things. So it's important to keep in mind that despite the economic evidence showing a bit of a slowdown, that the monetary policies from the global central banks can have quite an influence on equity markets in the short term. There is a but though, and there's one chart that I want to show you right at the end that indicates that the momentum in some areas might be slowing down enough to provide real caution about, I guess, the expansion or the pace and the continuation of this bull market that we've seen so far this year. All right, let's get stuck into it. First chart I want to show you is a chart of the Shanghai Composite Index. It's the Chinese stock market. A couple of weeks ago when I showed you this one, it broke up above support at around or resistance at around 3,000 points. It hovered around there for a few weeks and it looked like it might have been about to break back down below there. And I think at the time I said this chart was a good indication of Chinese liquidity going through the economy and the stock market. And as you've seen in the last week or so there, the Chinese stock market has broken higher again. So that really just goes to show that there's a lot of money flowing around, a lot of excess liquidity in China, and that often finds its way into the Chinese stock market. So certainly strong signs there for China. Next chart here is of the iron ore price last week. Iron ore broke out to its highest level since 2014. So that's once again an indication that China is, I guess, expanding in terms of infrastructure investment, fixed asset investment, and that's obviously good for Australia. Show you the next chart here. That's a BHP bulletin. When I've showed this one in the past, I've said this breakout, whether it's going to be sustained or not, it needs to hold above that breakout level. It's clearly done so there, and it's raced up to highs of around nearly $40, which is the highest BHP's been in a number of years. So clearly BHP's benefiting from China and the stimulus going on there. And really there's no sign of this rally running out of pace anytime soon. Obviously stock getting at multi-year highs is an indication of that, as BHP is. Rio is the same story. I don't have the Rio chart here this week, but it's virtually the same story as BHP. Next chart I want to show you, once again I've showed this previously, it's the emerging markets ETF. This chart also broke out to new highs last week, and that's once again just an indication of lots of global liquidity coming back into these emerging markets, looking for short-term returns. And I say short-term returns just because hot money tends to do that. When there's excess money in the market, it will flow into, I guess, the type of asset markets where you can get the best bang for your buck. And emerging markets often are considered to be high risk, high reward. So that's where the money's flowing at the moment. And the fact that it's breaking out to new highs just indicates that there's continuing money flowing into these markets at the moment. Next chart I wanted to show you is, I've showed this a couple of times in the past month or so. It's the Dow Jones Transportation Index. I've showed you this in the context of what is called Dow theory. And at the time when I showed this, the transports hadn't followed the industrial sector higher, and I said that could be I guess a divergence or a sign of caution in the market. But just in the last week or so, Dow Jones, the transports have also done well and broken out to new multi-month highs. Not quite as strong as the industrials index, but certainly there's a bit of money flowing into the transports there as well, which once again, it just indicates that there's a lot of liquidity flowing around the global economy. The final chart here I wanted to show you is, or sorry, not the final chart, but the next chart, which is slightly different to the others. It's the Aussie Dollar, US dollar index. The interesting thing about this is the Aussie dollar normally rallies strongly in a global expansion or when there's a lot of bullishness about or liquidity about, and in contrast to all the other charts I've showed you, the Aussie dollar just hasn't been able to rally at all this year, and you can see it's been in a downward trend pretty much since it peaked at 81 US cents at the start of 2018. So the Aussie dollar is telling you that the global economy is not recovering, and the rallies that we're seeing in all these other asset markets are largely to do with liquidity and short-term stimulus. And even China, the Aussie dollar normally rallies strongly on a China rebound. The fact that it hasn't done so says to me that the foreign exchange market is just not convinced that the Chinese stimulus is going to be long-lasting. All right, the final chart I want to show you this week. This is one I showed to my subscribers of crisis and opportunity in the weekly update last week. I think it's a really important one. It shows the S&P 500 continuing to rally, made a new high last week. But if you compare the ongoing new highs that the S&P has made with the panel down below, which is called the MACD index, won't go into the details of that, but it's effectively a momentum indicator. And you can see that momentum is starting to slow in the S&P 500 there, despite despite the index going on to make new highs in this rally. For me, that's a bit of a warning sign. It just indicates that the whole market isn't enjoying this rally. There's probably some key individual stocks that are hitting new highs, and the momentum underneath those major stocks is starting to give way a little bit. So for me, that's just a little bit of a warning sign that despite a lot of evidence that the global equity market recovery is continuing, the momentum that's underneath that recovery is maybe just starting to slow a little bit. Look, I've been wrong in my comments about the market topping out and looking for a pullback. Hasn't happened yet, but look, that just happens in markets. You know, when you're a long-term investor, you need to stick with the facts and stick with the, I guess, the fundamentals, the economic fundamentals. Clearly, the global economy is slowing. And equity markets are just benefiting from lots of liquidity. And for me, it's just a matter of time for how long that continues. We'll leave it there this week, and I'll catch you again next week with another update. Thank you.